Hello and welcome to Investors Guide. This is the second half of our year beginning special. Happy New Year to you, and I hope you have a wonderful 2015 filled with prosperity and happiness for your family as well. If you saw the show last week, you know that we have a wonderful panel of guests in the studio, and we have an audience joining us who have a lot of questions. Now, you can of course take down the email ID that's at the bottom of your screen, and you can send us any question that you have about your money. We will of course be with you, holding your hand right through 2015 as well, giving you all the advice you need when it comes to investing. You can reach me on Twitter as well. A quick introduction again one more time of the panelists who are joining us in the studio: Rashesh Shah of Edelweiss, Ramdev Agarwal of Motilal Oswal Financial Services, and Dhirendra Kumar of Value Research. Incidentally, all very successful entrepreneurs who've done really well and at the top of their fields right now. And I'm not going to waste any more time because we have so many questions to answer. The gentleman over there, go ahead.
Hi, my question is to Mr. Agarwal. Like, as a small investor, what are the avenues for me to ascertain the integrity and the capability of the management?
Good question about the management. You know, how do you assess a good management, terrific management? If you 90% is management, then you better be knowing how to see. Judging the competence is much easier, like whether his product is good or not, his service is good or not. That you can check if it is a motorcycle company, or if it is a cement company, or B2C. You can check it by being a dummy consumer, or actually checking around yourself whether these their products are good enough or not, or they are there in the market at all or not. So that part is competence part, whether they make a top quality product or good product or not. That is much easier. The issue is the integrity part. So you know, you can keep having the checklist after checklist. One is of course the word of mouth, and whenever there is a public perception about a management that it's a bad management, it's a crook, or it's whatever, I think you better give a lot of weight to that particular thing. You know, you go and meet the supplier.
Mr. I'm going to interrupt you very quickly.
Yeah.
A lot of times we, as retail investors,
Yeah.
we don't have access to a lot of the information. A lot of times it's difficult to even read through the balance sheet. A Satyam, for example, there was no way to see, or there was no way to understand or predict that that was coming. And that was an example of what happens when, you know, management goes wrong. So how do we guard ourselves from situations like that, or is that an unavoidable situation?
These are what is Six Sigma event or some rare events, and let's not be too much focused onto this one bad event. You know, like same way, you know, one crash in the market. People don't remember that in 30 years, this stock market has gone 100 times. It was 218, 84, and today it is 28,000. So we have to focus onto the positive aspects of it, and we have to be optimistic in the market. But coming back to his question, I think really figuring out that there is a good management, I think you have to be sticking to one or two businesses which you know very well for some reason. Every businessman or every investor knows few businesses very well. Say if you have some kind of a pharmaceutical background, or consumer background, or cement background, auto background, whatever, these 3-4 businesses you would definitely know, and you would know whether they are good or not.
Dhirendra, you had something to jump in.
I would just like to add to something in relation to your question, that you know, just looking at his answer in two parts, which is, you know, looking for a great company, looking for a competent management, and how do you validate that, you know, he is not a crook, the promoter is not a crook, you know, translating it. Internet is a phenomenal thing. If you are going to invest your lifetime savings into few companies, then go beyond the first page of the Google search. Go to the 30th page as well.
Rashesh, you had something to add.
So I would say you need to have the combination of both, a great management team and a great industry or opportunity space in which they operate. And the second thing I would add is usually the quality of a good management team is how they are doing within the industry. So you can actually benchmark the performance of a company, and usually you should only invest in companies where there is a track record of at least, you know, at least 5 to 7 years where you can see. And over 5 to 7 years, if you compare our particular company vis-a-vis their competitors and others in the industry, you should get a fairly good understanding of the competency and the capability of the management team.
And of course, like we keep saying, if that seems like a lot of work, invest in a mutual fund. You know, pass down the mic to the next person who has a question.
Yeah, so it is normally recommended that one must go for diversification while investing. So my question is, how must this diversification be facilitated such that we minimize our risks and maximize returns?
See, diversification is the biggest protection in downside of the equity. I mean, the real risk in equity investing is losing your own capital. Now you bought one stock and you put say all 100 rupees on that. what happens is if that stock is for some reason is unsuccessful, your entire life saving will go away. So the issue is you have to have about anywhere between 15 to 20 stocks from diverse field, maybe 7, 8, 9 industries, and beyond that diversification has no meaning. So it doesn't give the benefit of diversification. One of the reasons why you need instead of one single stock, you need a portfolio of stock of 15, 20 companies is that you can, first thing is you can lose only 1x in stocks. That's the beauty of it. And you can make 100x, 1000x, 5000x, give a long enough time. So say like you bought a stock and out of 14 stocks, say even 10 stocks go haywire. I mean they become actually zero. But 5 stocks go 100x, over say 20-25 years. So your total net return is going to be quite massive.
But usually when a couple of them do very well, you will find after 3 years that those 3 stocks, they'll end up becoming half your portfolio. And it is at that point of time that you come at this crucial point where you say, should I rebalance the portfolio, or should I, because I want to keep those stocks for 18-20 years and I keep that. So I think a little bit of rebalancing is what investors have to do, but usually that is a problem you have, and that is why I was saying that you need to review it from time to time and go back to the basics. But I think eventually you will end up with some amount of concentration in your portfolio over 5-10 years.
Dhirendra, if we pick an equity diversified fund, we're already diversifying across the market. How many equity diversified funds do we need? Is 5 enough, 6 enough from different fund houses? How do we diversify an already diversified fund?
It is a matter of how you approach that diversification. That diversification is needed purely from the point of view of marginalizing the risk of a fund manager, manager risk. I would say that having 2-3 funds gets you enough diversification, and anything beyond that, when you come across a portfolio that there are 20 funds of similar kind, I think it is better to have that index, save 1.5% on expense, and you'll be much better off with that because you are worse than an index.
Mm-hmm. So this is the takeaway when you're picking your portfolio and putting it together. Going with more funds or more stocks actually defeats the purpose. You have to bring it down, especially to a manageable amount, so you can take a look at it on a regular basis. We'll pass the mic down. You have a question? Yes, go ahead.
As an investor, to what extent should you rely on the balance sheet of a company or the quarterly reviews to judge a company's performance?
Yeah, I think the first and most important source of information about a company is the balance sheet. So it is very important because from where else you get the number. So electronic databases, they are rehashing only that number. So it is the most important, and the quarterly numbers are nothing but quarterly P&L, quarterly balance sheet. So it's just the kind of 4 parts additional on top of the last balance sheet. So it's an integral thing, and it is, I would think, in my at least calculation, it is at least 50-60% of the weights are. I mean, the starting point is balance sheet and P&L.
Rashish, I have a quickly follow-up question for you here. When we look at the quarterly numbers, how many quarters do we wait before we pick that as a trend, saying, okay, the numbers have been bad, or how deep do we have to go into why these numbers of this company has been bad before we decide to, okay, pluck the stock out of the portfolio and replace it with something else?
So I think it's important to wait for at least 4 to 6 quarters where you see that, but it's even more important to compare a particular company with others in the industry. And then, as I said, it's an industry call you have to make, and as long as you think the industry, it's only a cyclical downtrend in the industry, you want to stick to it. If there is a structural change, like if there is an innovation, disruptive innovation has happened, and the future of that industry is uncertain now, then you should ideally exit the industry completely. And again, hence it's actually very important to keep track. So it's all these are very eternal questions in terms of how short term or long term do you want to be. You don't want to react to every quarterly earnings, but you also don't want to wait for 5 years and then find out that every quarter it was going down and you were just waiting and waiting.
Welcome back. You're watching Investors Guide in ET Now. Thank you so much for staying with us. This is a very, very special episode. We're answering as many questions as we can. And you know, of course, that we're very partial to women investors on this show. So we have 2 young ladies in the corner there who have questions. Go ahead, ask your question.
So what would your advice be to someone who has just graduated from college and looking forward to investing? And what are the key learnings that you would like to give, and what should one keep in mind when he started to invest?
I think you want to make all your mistakes very early on, where the cost is very small, and you should see this as a continuation of your education. But you want to start investing as early as you can. I mean, I wish we had all started when we were 8 years old, because you will the experience that you will get in the early years will be invaluable. Second thing you don't want is to overtrade. I think this is when you are early on and you get some early success, you will be very tempted to say that I've got the magic formula because I went to ET Now show and now I know how to make money. So I'm going to go out and overtrade and borrow money and put all of that in the market because I want to make that instant money. So have real patience. Think about this as something you're going to do all your life.
One good thing about the stock market is that if there are a million investors, there are a million ways of making money. So you have to find your niche, your way of making money. So find early your hero. What style suits you? I mean, there are a lot of styles like say value style, growth style, penny stock, contrarian, your cyclical. So there are a whole lot of styles are there. So you have to find what suits your temperament for some reason and become master of that. Second, you got to find your hero very quickly. Third, you have to read a lot. And nowadays with internet, you got so much to read. I mean, Buffett letters, letters from all kinds of investors from all over the world is available free of cost to you. And then on top of it, you have the flood of books which you can pick and choose and read. At the early stage, you must understand there is no shortcuts to making money. Don't get into speculation, and understand, don't do investing in the name of speculation, or speculation in the name of investing. Be very clear about the definition of investing and speculation.
Dinendra, if I'm a brand new investor inclined towards mutual funds and not inclined towards stocks right now, what is your advice?
No, first and foremost, I would talk about something more basic. Congratulations for asking this question. You are well on your way. Because a lot of people at your age will be more concerned about spending money than saving it. And investing doesn't happen till you save, whatever be the scale. So that is first. If you are actually able to work on a target, because a lot of people think that a time will come when I'll be able to save, possibly for some people, but for most people it is more a matter of mindset. If you don't set a target for saving a X percentage of your income, you will never save it. You have just too many avenues to spend. So that is the first challenge. Don't invest in stocks or equity fund if you need that money in 1.5 years. If you are putting that money for buying that car 1.5 years from now, don't do that. Because every time the market goes down by 5%, you will think that, oh, I would have bought that big car, now I have to buy the small car.
I want advice from each of you on what parents who are watching right now with toddlers, 7-year-old, 8-year-old, 10-year-old children can do starting today to make sure that their sons and daughters grow up to not just have a kitty of money when they reach college, but also know how to manage that money, because it's not just about saving for your children, it's about making your children strong, confident money managers. And I want advice from each of you for parents who are watching.
True, as I said, you should start saving early, but you should start investing early, because I think in India we still have quite a few families who teach their kids how to save. You'll give a small piggy bank and the kids will save money. I hope it still goes on, at least it was there in our time. So I think saving is still in our blood. I think Indians, there is so much uncertainty in the world that Indians find it easy to save. But what I found is Indians don't find it easy to invest. So as I said, start investing early, and investing is all this going through the process of deciding, how you want to allocate your assets, what you want to buy. It's a very involved activity. It takes time and effort depending on what, how much involvement that you want. But and it is a highly experiential thing. I've seen most investors actually they get better and better as the years go by. I'm still yet to meet an investor who was actually very good when he was 18 years old and actually became very bad after 20 years of investing experience.
Ramdev, advice for parents?
Yeah, I think on the birth of, at least in India, this is the system that on the birth of a daughter or a dear son or whatever, people, all the parents and everybody, they give a lot of money or gold or whatever. I think that's the time, whatever is collected, I think they should buy some kind of SIP or, put the equity plan in action, high quality equity plan in action that very day. I mean, in fact, I was thinking of sending some relationship manager in the maternity, in the hospital, and find these guys what they think and all. You know, can we? Because that's the day to start.
Devendra, you have 2 young children of your own. Now we have child's bank accounts where you can, take a child to a bank and actually show them how to operate little ATM and make them feel proud of the fact that they can manage their own money. At what point do you think it's wise to bring your children into the family finances and start talking about, this is what these various investments are, this is how you invest your money, this is how you make decisions? At what point should parents start bringing their children into these conversations?
No, I think it should be from day one, because I think the most crucial thing, I wish my parents would have sensitized me to the financial well-being, or being financially not sophisticated, but being financially aware much earlier, as if it was something forbidden and it has to be it has to be kept as a secret among adults. I think it should be talked openly. I think the biggest challenge which I have faced, and I have succeeded to some extent with my kids, is sensitizing them to the worth of money. Because early on they actually get used to so much of consumption that they really don't so the moment they are sensitized to the worth of, or the value of money, what it can do for different families, savings and investments comes later. Of course, they need to understand the power of compounding, and once they understand, whether they are smart or not so smart is a function of time, as toddler. But if they really understand that if they are going to really spend this money now or demanding for something, they will have less for as and when they actually need it to begin with, will be a great learning.
All right, so start as early as possible, and of course it doesn't matter what age you're at right now. If you're in, just being born, or you're right in the middle of your life, it's never too late to start investing. Make this the year in which you start investing your money. Welcome back. You're watching Investor's Guide on ET Now. Thank you so much for staying with us. Happy New Year to you and your entire family. We hope you have a wonderful New Year. If you just tuned in, well, you missed most of the show, but we have 3 wonderful guests in the studio who are answering questions from investors who've joined us here. Go ahead, sir. You have a question.
My question is from Mr. Dhirendra Kumar. Sir, you normally advocate goal-based SIPs, say for 10 years or 15 years for marriage of our child, or for higher educations. Suppose and over 15 years goal, we keep on doing SIP for 13 years, and remaining 2 years we withdraw our money in SWP, systematic withdrawal plan. Suppose in those 2 years we come across a market crash which happened in 2008. How can we deal with that to minimize our losses?
Assuming that it was 2008, and assuming that you were doing the SIP for last 10 years, and 2008 happens, and 2008 happens at a time when you had next 2 years you had planned for that withdrawal, you will still be okay, because 2009 happened, market bounced back, then 2010. So it will not be it will be bad luck, but it will not be all that bad. But if you were to take all the money on 17th of January 2008, then I don't know. You shouldn't really attempt that. But generally speaking, I would imagine that if you have accumulated your money for next 12-13 years, over the next 12-13 years, I would expect that you will need 25% of that money over the next 1.5 years. That will typically be the goal, and that I don't think. And if you have actually converted, if you have all this thing converted into different goal-oriented portfolio, one was for your retirement, one was for your child's education, the other one was for your daughter's wedding, then you will still not be as upset, because for the other things you will not be put your hands on those. So you will not be as disappointed. Having a methodical investment plan and having a methodical withdrawal plan is just as important for a goal-oriented savings.
All right, I'm going to quickly take another question. Go on. The gentleman with you.
My question is with Ramdev sir. So you are talking about equity investment only. So what are the prospects in investing in commodity, and if I want to invest in commodities, so what are the source of information? Say if I invest in equity, then I have the balance sheet and all this stuff. For commodity, I found it those jokers basically. So I don't found. So what are the source of information for if I want to invest in commodity?
There are 3 types of assets. So I personally don't think gold and all are actually investment asset class fundamentally for educated and well-informed people. At best, if you are scared of volatility in equities, you can go for fixed income, but not definitely not in gold.
Okay, I'm going to have to stop you there because we're running out of time. But before we wrap this show up, I want a word of advice from each of you for investors who are watching, retail investors, long-term investors, investors like we have in the studio today, that they can use, internalize and take through this new year. Rashesh?
What I've learned is investing is an emotional exercise. The idea is to actually balance your emotions with the rational part, and ideal should be 80% should be rational and 20 emotions, and it should not be 80 emotions and 20 rationals. So I think control your emotions, and the second part is have faith in India. I remember 20 years ago this country was only a $400 billion GDP country. We are now close to $2 trillion. I think by 2025 India will be a $5 trillion GDP country. So if India is going to grow, corporate earnings are going to grow, and if corporate earnings are going to grow, equities will do well. So I think especially when markets are very volatile, markets are falling, to keep that faith in the long-term evolution of India, the long-term growth of India is important.
Yeah, one strong advice against investing in, for investing in equities is don't time the market. I think people are timing the market by the hour, by the day, by the week, by the month, and depressed market they don't want to get in, slightly higher market they don't want, I don't know when they want to get in. So this entire continuously timing the market at the extremes, absolutely at the extremes, like you are at 30p, 25p, and people are, even the shoemaker is talking about kind of stocks and all. Probably that time you need to be swollen river, you need to be a little cautious. But otherwise, this is a very warm, nice market, 16, 17, 18p multiple, new government has come. I mean, you should not sweat too much. In any case, nobody can time the market. I mean, that's the fun of the market, that nobody can time it. So I think one must not put any energy into timing the market. If you have money, go tomorrow, 9 o'clock, first thing, go and buy and be done with. It's like taking a dupki in Haridwar, just go and take the dip.
No, I have I'll be at the cost of repeating it. Create a plan and stick to it. Don't get into anything which you know nothing about. Something like commodity or this, that, just because a lot of people are talking about it. Third is, just at the cost of repeating all what others have said, that for all your long-term savings, the money which you don't need for 5 years and more, have it in equity, and be methodical about it. If you can find a great stock, go ahead, do it. If you can't do that, choose a good fund. If you can't do that, choose an index fund. But get into it. Trying to find the perfect plan, you'll never have it.
All right, so the advice that we've received on the show is very simple. Keep it simple. If there's something you don't understand, stay away from it. You have to have equity in your portfolio, and there are many ways to do that. There are many simple ways to do that. One of those ways is to write into us on the show, and it'll be our pleasure to hold your hand through all of it. Remember, health insurance, life insurance, emergency fund. Before you start anything else, you have to have these 3 things in your kitty. Gentlemen, thank you so much for spending time with us. We're going to take a commitment from each of you that when people write in and ask us questions, that you'll be kind enough to answer those questions on the show. Virendra, as always, we look forward to spending 2015 with you. Next week on Investors Guide, the top mutual funds from 2015 with Virendra Kumar. All the audience who came in, it's a pleasure to have you on the show as well. Thank you for being regular viewers of Investors Guide, and thank you for watching.